Bonds, the pros and cons of bonds. Stocks, the pros and cons of stocks. The pros and cons of bonds are usually they're safe. They get a lot less of an income, but they're safe. Dividend producing stocks, on the other hand, can give you an income that's higher than bonds. A lot of people who are equity investors like stocks because they will gain in value. If you look at Elon Musk, his stock skyrocketed in value. Volatility, meaning the price will go up and down in a lot of things in stocks. Bonds are a safe haven for rich people usually. If they believe that the market is going to go up and down, up and down, up and down, or just going to drop, they retreat into bonds. And they can take a little bit of money. And then they wait for the market to correct itself, and then you get back into the market. A lot of people do that. Not everyone does that. That's a strategy. Safety. You want 100% safety? A lot of people try to go to bonds. They actually look at it as a safe haven for their assets. My opinion, I prefer the stock volatility over the safety of the safety. In a down market, like currently we're in a down market most of the time. A bear market is a negative 20% drop, a 20% drop. So if you had $100 worth of stock, it goes down to 80. A lot of people will run straight into the bonds when they see that the stocks are going down. That's the time I purchase stocks. I like to purchase stocks when the value goes down. Two things is going to happen. Two different things. One, in my opinion, the stock will regain its value eventually. In my opinion. In the past, usually the price of the stock market goes up 10% a year. Usually. Doesn't always. There's sometimes that the stocks are down. Usually they go up in value. A bond, you buy $1,000 bond. Say it's got 1 year to mature. Say it pays you twice a year. Okay? And then you get your equity back and you get interest. Equity and interest. So if you have $1,000 bond and they pay twice, you usually would get half. You probably would get your half of your equity back, and then the half of the interest, and then the second time if it pays twice a year. I prefer dividend producing stocks over bonds. So if you're making 5% or 4% or 3% on a bond, you don't have to worry about your equity going down. If you buy $100 worth of stock and the equity goes down 10 or 12%, the value of the stock is now worth $88 to $100, $90. If it was 88%, $100 worth of stock is 88. If it was 90%, the stock is now worth 90. If it's an income producing stock, like ARR, ORC, or one of the others, it will give you a percentage. It will give you a dividend. Now, the dividend may not make up for the equity lost short term. In my opinion, long term it will. Right now, the equity position of ORC has dropped. The yield also has dropped. But the new yield is about 18%. So if it maintains at 18% and you keep it for 3 years, 20, 40, 60, 56. I think it's like 56%. It's 3 times 8 is, no wait, 18, 18, and 18, 10, 20, 30, 40, 50, 54%. So now I got 54% of my money in cash in 3 years. And then if the stock rebounds, I'll get the equity back. It may not happen. Volatility. But if you're trying to make sure that you don't lose a penny, you might lose $1. The safety of a bond, you just buy a bond for a year, you're okay. All right? And then you wait for the volatility, and then you buy the stock, and then you notice the stock price starts going up and up and up, and then people buy stocks. I prefer to buy stocks when they're low, and if I have to sell, I would rather have him sell them high. But the safety of a bond is what a lot of people think. Now, really quickly, there's government bonds, like municipal bonds or cities have bonds that they'll sell you so they can improve the city, and then they'll give you interest on your money. There is a company that secures municipal bonds, so they will guarantee that you'll get your interest and premium back. So you go to that company, and they will make sure that you get your money. They have plenty of equity to pay in case those cities don't do it. But they also help the cities and show the cities what they can do to make sure that they make the payments. So municipal bonds. Federal bonds is the federal government issues bonds, and it can be long-term bonds, and it'll be a percentage. I don't know whether it's 3, 4, 5%, but it is usually considered very safe. There's very little upside. You're only going to get your money back plus interest. So the price of the bond is unlikely to double. So the only thing that you're looking at is a steady stream of income that's lower. It's safe. With stocks, it's higher potential yield and higher upside. Have a nice day.